Hello and welcome to Buy Africa, the show where we focus on investment opportunities around the continent. I'm Tshepo Modiba, and thanks for joining me. Tonight, I'm joined by Peter Baird, Managing Principal for Investec Asset Management's Africa Private Equity Funds, for a look at investment opportunities available in private equity markets across the continent. Peter, thank you for joining us.
Tshepo, thanks very much for having me.
I'll start out with an easy one. I'm pretty sure I know the answer that you're going to give anyway. One of the key theses that's come up is, I guess, the merits of investing either via listed vehicles on the continent or private equity structures. And there's a leaning towards private equity until African markets are a little bit more developed for listed investors to actually participate in the African growth story. I'd like to get your sense of that broad thesis.
Sure, but first we should be clear, we're talking about big institutional investors, long time horizons, and not retail investors who may be thinking for a short term or for kind of a more speculative thing. Overall, in public equity and in private equity in the African continent, liquid investments are hard to come by, and the capital markets are not very deep and they're not very efficient. So the normal benefits you'd have in most markets of publicly traded equities or fixed income, you generally don't have outside of Johannesburg, some in Nigeria, particularly in the banking sector. In some of the other markets, maybe one or two counters. But by and large, the line between public equity and private equity is pretty blurry. So the advantages of a private equity firm are probably more manifest here than in most markets.
Okay. And drilling into the private equity space, I guess, how does one, or what defines a good private equity potential investment? How do you go about assessing what may be profitable or not?
Well, so most firms have different investment styles, and they'll have different investment strategies. I think what we like to focus on, and without hard and fast rules, because there are always good opportunities, but generally things that we like to see. By geography, there are a few geographies that we find particularly attractive, and actually we put right now South Africa, Botswana, Zambia, kind of some of the Southern African, in East Africa, still Kenya, although some concerns, but Uganda, Rwanda in particular. Ghana, very attractive. And then others where you just have to be a little bit opportunistic and assess geographically. Our investment style, we have migrated over time. We are by tradition growth investors, but we've become much more focused on controlling investments either alone or in a consortium. So opportunities where there is an ability for us to buy control either with partners or on our own, that's attractive. Some basic characteristics of the business: cash generation, critically important, sustainable cash generation, identifiable competitive advantage that is durable and can be built upon. And then what we really like is strong, stable bases with good export opportunities from there. So we're trying to build regional champions. We're trying to build great African companies, but starting with a very stable base and then growing on the back of that, as opposed to early stage or greenfield or cash absorptive type companies. So in summary, some geographies, business model which is cash generative and highly defensible, and then strong management team and an ability to work with that management team from a control position.
Before we delve into the regional differentials, what in particular or how much does the underlying macroeconomic growth actually filter into your analysis? Is high growing countries a better opportunity set over ones that growth is a little bit more petered out?
So it's a good question. I wish there were a really crisp answer to it. Generally speaking, good economic growth helps everybody. Rising tide lifting all boats. That said, even in tough times, there can be good opportunities in terms of reasonable entry valuations, or companies which are very diversified across multiple geographies. So recent economic challenges haven't really, I think, scared us off. I think, if anything, the currency blowouts have helped us as buyers. And the existing portfolio, it's a bit of a challenge, but has also sort of made people more amenable to taking private equity. So macro growth is very helpful, but you like to sort of buy in macro stagnation and sell into macro growth when valuations improve. Overall, though, we're through the cycle investors, and we're looking for fundamentally strong, good companies that will do very well when the economies are growing fast, and will do reasonably well when they're stagnant.
Okay, let's go to the regional picture. What drives your assessment between the different regions? Are you particularly bullish? I know you spoke a little bit about a little cautious over East Africa. What drives your assessment of the differential across the different regions?
I think in terms of macro, it'll come to two things. One is sort of true growth drivers, exogenous and endogenous, and the second would be policy. And there's always cycles in all of this. So if you look at kind of the three main regions, Southern Africa, East Africa, West Africa, the big overlay is going to be sort of dependence on commodity exports for growth. So Nigeria has had kind of a triple whammy where overvalued currency and it had an overvalued currency, real reliance on commodity exports, particularly oil, and then some in-transition economic policies. I think the economics team there is very strong, and they're trying to do the right things, but they inherited a situation which was quite brittle. So they've really had a tough time, and we hope they've reached the bottom. Now the currency much more reasonably priced, a lot of macroeconomic reform, but it's tough, and they may have done some relatively long-lasting damage to that economy. If you look next door, though, in Ghana, which sort of which had a very serious economic meltdown, but a couple of years earlier, then you had, so the currency underperformed. We had a fair amount of macroeconomic reform. They're less dependent on oil as an export, but they are highly reliant on cocoa and on gold. They've actually come through the cycle, so they're in probably 2 years ahead of where Nigeria is in terms of macroeconomic recovery. So when you look at a region, Nigeria is the biggest and can't be ignored, and there will always be good opportunities there. But again, next door in Ghana, we're probably seeing a lot more interesting stuff. East Africa is slightly tricky. Kenya is the main economic driver there, and the EAC is, we think, a very exciting development. But Kenya was benefiting because Kenya essentially imports all of it doesn't export commodities. It imports all its fuel and all of its sort of commodity-based intermediates and raw materials. So when commodity prices came off, Kenya actually benefited quite a lot. It also, in the intervening period since its last election, it's had good stability, good macroeconomic reform, good monetary policy, and a reasonably priced currency. So the Kenyan economy has done very well and attracted quite a lot of fixed investment. Now, with the election coming and with all of those reversals, so now all the things they're importing have become more expensive, you could see a little bit of headwind there. Tanzania we like a lot, needs of some economic reform to keep pace with their EAC neighbors. Rwanda we like a lot, Uganda, but they're just a little bit small. But as a community, East Africa is still pretty interesting and has multiple growth drivers. And then in Southern Africa, South Africa has really had a hard time, in large part due to commodity price cycle. I think a need for some economic reform and clarity of economic policy. But South Africa is a big, strong, endogenously driven economy, and will, we think, do quite well over the next few years. The most important thing in South Africa was they had the shock absorber of the currency. So when the macroeconomic picture was quite bad and commodity exports were weak in volumes and prices, you had a big reaction in the value of the rand. I think the rand now probably fair to slightly oversold, but what that does is that allows the whole economy to adjust. Then you just look at tourism as the best indicator. Tourism, one of South Africa's most important exports. Tourism here became very, very cheap with the rand, and you've seen a big pickup in demand of tourism, not a surprise. But because it had that shock absorber of the currency, South Africa will come out of this, out of its economic troubles much more quickly and much more strongly than it otherwise would. Plenty of challenges, plenty of reasons for risk, but we're, I think, quite bullish on the South African economy for private equity. And then the nearby Botswana we like a lot. Many of the same reasons. Currency there actually is partially pegged to the rand, also partially pegged to special drawing rights. So it hasn't been as weak, but the pool again looks a little bit, if anything, slightly oversold. So you get a bit of a tailwind from currency. Zambia, copper price really hammered that economy. Now the copper price is back up, and the Zambian government doing a lot of sensible things in terms of economic reform. We like Zambia as well. That's sort of how, in very broad brushstrokes, how we're thinking about it. A fair amount of analysis goes underneath that, and I think, economic thought. But in terms of companies which are dependent on their local macroeconomic environment, that's kind of how we're seeing the world.
Okay. If we then move, I like to hear the word bullish, which you threw out a couple times there. If we move to, I guess, an underlying sector perspective, what makes you excited about the outlook for private equity for the next 5-10 years from an opportunity set right now?
I think, first, so private equity, like any other source of capital, is subject to supply and demand. I think there's been supply of private equity capital has been reduced over the last few years as big institutions have sort of either pulled back from this market or stood on the sidelines, or just decided maybe Africa's a little bit too racy for them. So here we're very committed to these geographies, very committed to this sector, this product space. So we're investing through the cycle. And I think as other people have pulled back or maybe rethought their strategy, the supply of capital has been less. There are also competing sources of capital, permanent capital vehicles, mezzanine debt, all the rest. A lot of that has pulled back as well. So supply of capital in these markets has been reduced. The demand has, if anything, has increased because you see a lot of good growth companies. You see a lot of companies which essentially got overextended and have had distress. So you see the demand for our capital has increased, the supply has decreased, and effectively that means that there are a lot of opportunities at better prices on better terms. And I think we have to still go out there and originate and work hard and then add value to these companies and ultimately exit them. And I'm hoping that a lot of that capital will be coming back in 3 or 4 years from now when we're looking to exit. But in the meantime, I think the opportunities look very good, and there are a lot fewer people chasing them.
Perfect. Let's leave it there, Peter. Thanks to my guest, Peter Baird, Managing Principal for Investec Asset Management's Africa Private Equity Funds. That's all from Buy Africa this week. Remember to follow me on Twitter, that's @Modiba_Tshepo, and send us your thoughts about the show using the hashtag BuyAfrica. From myself and the team, goodbye.